Hi, my name is Jeff DeWeese, and I'm the Chief Investment Officer at ORIC Capital Partners. Today we're going to talk about a potential market bubble and de-dollarization. Markets are red hot right now. Stocks are at record highs, margin debt is surging, and we're seeing echoes of 2021 speculation. But while most focus on this potential bubble, there's a quieter but equally important shift happening globally: de-dollarization. Let's start with what's happening in the US markets. The S&P 500 and Nasdaq are making new highs. AI stocks are trading at 20 to 40 times forward earnings, in some cases with no profitability. Meme stocks are back, and margin debt just crossed $1 trillion again. Margin at elevated levels is concerning because it amplifies both gains and losses. Investors using borrowed money can buy more assets than they could with cash alone. That is great when prices go up, but if they fall, losses are amplified, which can lead to margin calls. In a margin call, investors are forced to sell, often accelerating a downturn. This dynamic played a major role in 2000 with the dot-com crash, 2008, the financial crisis, and 2021, the meme stock unraveling. This feels familiar, like 2021, only this time the narrative is driven by AI and the expectation of rate cuts. The concern isn't just valuation, it's also concentration. Mega caps are driving almost all the market gains while breadth is thinning. While investors chase upside in domestic assets, the foundation of the financial system, the US dollar, is gradually eroding its dominance. The dollar share of global reserves has dropped to 58%, down from 70% in 2000. Central banks are buying gold and settling trade in local currencies. Smaller emerging market countries are starting to adopt cryptocurrencies. Sanctions, tariffs, and growing debt are accelerating a shift towards currency diversification. Crypto, gold, and the trend toward local currency trade settlement are all connected by a shared driver: growing global distrust of the US dollar and Western financial systems. While they differ in form and credibility, they reflect a common goal: financial independence from centralized dollar-dominated structures. This isn't about the dollar collapsing tomorrow, but the long-term trajectory does point downwards. Here's the intersection I think we should pay attention to: a speculative bubble at home and a global move away from US financial system abroad. They may seem unrelated, but both reflect a deeper issue: waning confidence. At home, in fundamentals; abroad, in the dollar and US fiscal policy. If confidence falters in either, the consequences could be fast and asymmetrical. This is another reason why diversification is imperative in structuring a portfolio today. With it, you can reduce risk and still target returns that will help you achieve your financial goals. As always, stay calm, stay diversified, and stay positive. From all of us at ORIC Capital Partners, we wish you all a great day.